Assalamu alaikum warahmatullahi wabarakatuh. Maanta waxaan ka hadlaynaa waxa la dhaho raising and maintenance of capital. Raising finance waxa weeye in horta dhaqaalaha la kobciyo. A company may finance its activities in a number of ways bay dhaheen. It could simply obtain an overdraft from its bank. It could buy equipment on higher budgets, terms, or release it for borrowing or sustainable sums. Or for long-term borrowing waqti dheer in maaragtay it will often issue debentures at a fixed rate of interest. They are attracting will depend on their tax advantages and comparison of levels of income derivable from interests and dividends on shares. An investor might make a capital contribution to the company. Through it may it be difficult to determine whether it's a loan or to be treated as non-repayable shares, what they call premium shares. Shares provide the initial finance for most companies, just as a company's securities may be divided into shares and debentures. So may there be ordinary shares or one or more class of preference shares to appeal to the desires of different investors. Different classes may be created on the company formation or at the later. And the rights of any preference shareholders are limited to the terms of issues of his class of share. If he is entitled to fixed rate or dividend, prima facie he cannot be participated marka horeba in remaining income. And if an annual dividend is not declared, only a cumulative preference shareholder can claim errors. He may be paid off on a reduction of a capital, or if his shares are redeemable by redemption, which is normal value, and he is not necessarily able to vote at the meetings in any respects to his position comparable with that of the debenture holders. Inta waa fahnay, we all understand. Capital share may be nominate capital. The amount of money waxa way its memorandum entitles as a company to raise, and this might compromise issue of share capital and unissued share capital. Paid up capital represents the money actual received from share issues. Uncalled capital, the amount is still owed. Reserve capital is uncalled capital with the company has resolved only to call up a liquidation. Most shares today are fully paid up and often worth more than their normal values. Shares might be issued as a premium. The extra value must generally be transferred to the share premier account. We extra. So premier baa la dhahaa. If you pay more than expected, that is premier account aa lagu sameynaa. Profits waxaan ku sheegnay sharciga Somali company law. Profits undistributed as income are kept in a reserve fund baa laga dhigayaa. Dhaqaale kaydaa la dhigayaa. The nominal value of his maaragtay shares indicates the maximum the number has to be contributed to the company liabilities, but says which is it says nothing about the company's worth. Ma tilmaamayso their market price kooda, especially as fixed asset loss need to replace it. The company's share structure could be rationalized either by capitalizing the sums in the share premier account or reserve fund by reducing capital. Raising capital the liability of members of a limited companies is limited to the nominal value of their shares. Certain rules help to ensure credits guarantees fund, which is not illusion. The nominal value of a public company share capital must not be less than the authorized minimum. 1/4 of the nominal value of all issued shares of the public company plus any premiums must be paid up. Shares must not be issued at a discount value. Debentures might, unless there is an immediate convertible into equal value shares, like caseka Mosley iyo Covey Font 1904 wixii dhacay. Kiiskaasaad you can review that case. A commission may be paid to underwrite. Shares may be allotted for money or a money worth. If a public company shares are allotted for money's worth, the consideration for the allotment must be valued by an expert. Qof khubuuro ah oo khabiira loo baahan yahay inuu qiimeeyo haddii lacag ay noqoto, whose report must be made to the company and made available to the allotee. Maintenance of capital waxaa niri prima facie isla marka horeba capital cannot be returned to the members by the company. Inta waa isla fahna. They might recap their investment by selling shares to others. Dadka kale ka gadi karaan. In general, a company cannot acquire its own shares practice which would enable directors to manipulate share values depending on the price paid for the shares which the company brought. For share. So let us summarize. Raising capital involves acquiring funds for business operations, while capital maintenance ensures the company preserves its capital to sustain operations and profitability. Raising capital maxaa niri waa equity financing, debt financing. Equity financing maxaa niri this involves raising capital by selling shares of the company. Investors receive ownership stakes in exchange for their investment. This method can include initial public offering, IPOs can construction, and private placement. Equity financing does not require repayments, but it dilutes ownership among existing shareholders. Debt financing, companies can also raise capital through loans or issuing bonds, which requires repayment with the interest, but it does not dilute ownership. Debt financing can be cost effective way to raise funds, especially if the company has a strong credit rating. We don't use sometimes in Islamic ways. I don't know. Let us just research. Capitalization of profits. Wow, companies can reinvest their profits back into the business instead of distributing them as dividends, which helps growing the capital base without incurring debt or diluted ownership. Marka waxaan niri capital maintenance concept is a principle ensures that a company capital is preserved over time. States that a company cannot only recognize profits after recovering its costs. The capital maintenance concept can be categorized in two different the main financial capital maintenance and physical capital maintenance. That is the main two types of maintenance concepts. Financial capital maintenance is a profit recognized only if the financial value of net assets at the end of a period exceeds that at the beginning, including any contributions and distributions to the owners. Physical capital maintenance is a profit recognized based on physical productivity capacity of the company, which means that the company must maintain its operational capabilities, which is good. So legal framework waxa waaye various statutory and common law rules govern the raising and maintenance of capital. Public companies must meet minimum subscription requirements for commencing business, and shares cannot be issued at a discount. This regulation is made by governments is designed to protect creditors and ensure the company maintains its capital integrity. Importance of capital maintenance is crucial for a company's long-term sustainability. It ensures the business can be continued to operate, invest in growing opportunities, and meet its financial obligations. Any failure to maintain capital can lead to insolvency and loss of investors' confidence, which makes the company to collapse totally. And it happens. So raising and maintaining capital are essential functions for business, ensuring that it has to be or necessary resource to operate effectively while safeguarding its financial health. Thank you very much. Let us see the next.